Ever wondered how the concept of leverage works in Forex trading? Well, let's break it down. Picture leverage as a tool that magnifies your trading power. It's like borrowing a certain of money needed to invest in something. In the context of Forex, this money is usually borrowed from a broker. Now, what sets Forex trading is the high leverage it offers. Imagine this. For an initial margin requirement, which is basically a deposit, a trader can control a significant amount of money. So if you're required to deposit just 1% of the total transaction value, you can hold sway over a sum that's 100 times larger. This is the heart of leverage in Forex, your capacity to control large amounts of money with a relatively small investment. Now that we've introduced the concept of leverage, let's dive deeper into how it works. But before we do, make sure you subscribe to the Guardian Forex TV, so you never miss an episode in this enlightening series. Go ahead, hit that subscribe button now. And just a reminder before we finish, if you found this video useful, don't forget to subscribe to the Guardian Forex TV YouTube channel for more content like this. Appreciate your support. How exactly do we calculate margin-based leverage? Let's dive right in. To grasp margin-based leverage, we need to understand it as the total value of the transaction divided by the margin required. Sounds cryptic? Let's break it down with a real-world example. Picture this. You're all set to trade one standard lot of USD CHF, which is equivalent to $100,000. Your broker requires you to deposit 1% of this total transaction value as margin. So in this case, you'll need to put down $1,000. Now, how do we calculate the margin-based leverage? It's simple math, my friends. Just divide the total transaction value, which is $100,000, by the margin required, which is $1,000. The outcome? Your margin-based leverage is 100 to 1. In essence, with just a 1% margin, you've been able to control a transaction worth $100,000. It's like being at the steering wheel of a supercar with just $1,000 in your pocket. But what if your broker only requires a 0.25% margin? Using the same formula, your margin-based leverage skyrockets to 400 to 1. That's 4 times the power with the same amount of money. However, always remember that leverage can be a tricky business. It's like a superpower. It can amplify your profits, allowing you to earn more from the market's small price fluctuations. But on the flip side, it can also magnify your losses. This is why it's crucial to have a solid understanding of leverage and how it works before you start trading. It's not just about the potential profits, it's also about the potential risks. And the more you know, the better you can manage those risks. So, with just a 1% margin, you've been able to control a much larger amount. But remember, leverage is a double-edged sword. It can either work in your favor or against you. So trade wisely, my friends. How can leverage act as a double-edged sword in Forex trading? Now that's a question worth exploring. Picture this. You're a swordsman, and leverage is your weapon of choice. It's sharp, powerful, and can help you conquer the battlefield, the Forex market in this case. But with every swing, there's a risk. You might strike gold, or you might just cut yourself. That's the essence of leverage in Forex trading. Leverage, in its purest form, is borrowed capital. It allows you to hold a trading position larger than your actual cash balance. It's like a magnifying glass, amplifying both your potential profits and potential losses. This is where the double-edged sword analogy comes into play. Consider a live trading scenario where you're using high leverage. Small price changes in currency pairs can lead to significant profits. It's like striking an opponent with the sharp edge of your sword. But remember, the other edge is just as sharp. If the market moves against you, the high leverage can magnify your losses. And just like that, you're on the receiving end of the sword, facing potential damage to your trading account. On the flip side, let's look at a situation with low leverage. The potential profits from small price changes are less, akin to a duller edge of the sword. However, the potential losses are also less, providing you with a sort of protective shield. In both scenarios, leverage is the common factor. It's the sword in your hand, and how you wield it can significantly impact your trading outcomes. High leverage might tempt you with high returns, but it also exposes you to high risk. On the other hand, low leverage provides safety but with potentially lower profits. And that, my friends, is the crux of leverage acting as a double-edged sword in Forex trading. It can amplify your profits when the market moves in your favor, but it can equally amplify your losses when the market turns against you. As you've seen, leverage can significantly impact your trading outcomes both positively and negatively. Let's recap what we've learned about Forex leverage. Leverage, as we've seen, is a powerful tool in the world of Forex trading. It's the use of borrowed funds, often from a broker, to increase one's trading position beyond what would be possible with their cash balance alone. This ability to magnify your trading capacity is what makes Forex trading so attractive to many. We've delved into the concept of margin-based leverage, where you divide the total value of the transaction by the amount of margin you're required to put up. This gives you an understanding of the leverage you're employing in your trading strategy. For instance, if you're required to deposit 1% of the total transaction value as margin for a standard lot of USD CHF, equivalent to $100,000, the margin required would be $1,000, giving you a margin-based leverage of 100 to 1. But while leverage can amplify your profits, it's crucial to remember that it can also magnify your losses. This is why we refer to it as a double-edged sword. You could profit from relatively small price changes in currency pairs, but you could also incur losses from these same small changes if the market doesn't move in your favor. That's why it's so important to use leverage wisely. It's not just about chasing the potential for high profits, it's about carefully managing your risks. This involves not just understanding how to calculate and apply leverage, but also developing a clear, well-thought-out trading strategy, and always keeping an eye on market trends and indicators. Remember, understanding leverage is key to managing your risks and maximizing your profits in Forex trading. We'd love to hear your thoughts and experiences on this topic. Don't forget to comment, share, like, and subscribe to stay updated with our latest videos. Happy trading!